What breaks first in a banking panic? The assets, the rules, or the story people tell themselves about safety? That's the question. For most of us, a bank is a building and an app. You deposit a paycheck, you tap a card, the lights stay on. Under the hood, a bank is a timing machine. It borrows from you short and cheap, on demand at par, and lends long and uncertain to mortgages, businesses, bonds that wiggle when rates move. When nothing's wrong, that mismatch funds growth. When something's wrong, the very feature that makes banks useful becomes the fault line. Start with confidence because confidence is the first asset any bank holds. Deposits may look like the bank's money, but they are the customer's nerves, priced at zero and withdrawable at the speed of a thumb. For a century, panics moved at the pace of rumor and bank lines. Now they move at the pace of a push notification. Group chats replace sidewalks. Screenshots replace whispers. If your largest depositors are a handful of CFOs, not a million households, the crowd is a Slack channel. One message, we're wiring out to reduce risk, and billions sprint for the same exit. The balance sheet doesn't change in that second. The belief about the balance sheet does. And belief is the fuse on which all the other problems ignite. Next in line is liquidity, the ability to pay good money today without selling the future at a loss. Banks hold safe assets for this: cash, reserves, treasuries, agency mortgage bonds. They're safe in credit terms. They are not safe in price when interest rates jump. Here's the plain English version of duration risk. When rates rise, the market value of long bonds falls. If you can hold to maturity, the bond pays out as promised. But in a panic, holding to maturity becomes a luxury. You don't need money later, you need it now. That's when the accounting boxes, available for sale versus held to maturity, stop being labels and start being a trap. Losses that looked theoretical the day before turn practical when you have to sell the thing to fund withdrawals. This is why panics often begin with a speed mismatch and then morph into a price problem. A bank can be perfectly solvent on paper and still fail because it cannot turn assets into cash fast enough at par. The fire sale is the killer. You sell what you can, not what you want, and selling pushes prices down further, which marks other balance sheets lower, which tightens lenders' haircuts, which forces more selling. The loop is mechanical, not moral. Collateral lives at the center of that loop. In normal times, treasuries are more than investments. They are the grease of the funding machine. You pledge them in repo, borrow overnight, roll tomorrow, repeat. In stress, lenders demand higher haircuts, more collateral for the same cash, or they step back altogether. Funding that was automatic yesterday becomes maybe today. This is the plumbing version of a panic. Your assets haven't defaulted, but your access to transform them into spendable dollars has. That loss of access breaks markets before bankruptcy ever arrives. Deposit structure decides how much time you have. Retail deposits, thousands of small accounts, tend to be sticky. Uninsured concentrated deposits, dozens of large accounts, are not. If your base is local businesses and high net worth money above the insurance cap, you are funding short with jet fuel. It's cheap and stable right up until it isn't, and then it all moves at once. That's why in postmortems, you always hear the same three lines: large uninsured deposit base, asset duration too long, unrealized losses on securities. None of these is scandalous alone. Together, they are a choreography for a fast run. People ask, why not just raise capital? Because equity is the most expensive when you need it most. Imagine calling investors during a run to say, we need billions today to show strength. The market hears, the hole is big. Your stock trades like an option on survival. Issuing equity at a collapsing price dilutes the franchise and still might not stop withdrawals. Capital fixes solvency. Panics punish liquidity. The clock doesn't always give you time to get from one to the other. Payment rails can turn stress into crisis. Banks don't just hold assets and liabilities. They are nodes in a network. They clear payments for each other. If counterparties worry you won't open tomorrow, they trim lines to you today. The customers never see that decision on a screen, but it shows up as delays, limits, cutoff times moved earlier. Pull enough threads in that web and ordinary commerce feels sticky. Vendors ask for prepayment. Payroll providers demand cash in earlier. The system is designed to be robust, And yet its speed is also its fragility. The same technology that makes money real-time makes fear real-time too. You can see how regulation tries to catch this. Liquidity coverage ratios push banks to hold more high-quality liquid assets. Stress tests model outflows. Supervisors tell firms to know their deposit concentrations and their survival horizon under stress. It all helps until conditions land outside the model. A single sector shock, a social media rumor, a sharp rate spike, or a combination of the three can overwhelm parameters built from yesterday's storms. Models are maps, panics are weather. What about deposit insurance? It's the fire break against retail runs. But insurance has limits. It soothes small accounts and buys time, not absolute safety for every dollar. Businesses need balances larger than the cap to pay vendors and payroll. If a handful of large customers leave, the arithmetic of how much to sell, how fast, at what price, doesn't care that the first X dollars per account is insured. That's why crisis playbooks often rely on emergency liquidity, a lender of last resort, discount windows, swap lines, or special facilities to lend against high-quality collateral at terms that stop the fire sale. These tools don't reward bad behavior. They preserve the payment system while facts catch up to fear. History draws the sequence clearly. In 1907, trust companies faced runs when confidence cracked, and private pools of capital acted as the backstop of last resort. In the early 1930s, thousands of banks fell before deposit insurance existed and payments ceased. In 2008, it wasn't paying retail deposits that broke first. It was wholesale funding keyed to mortgage collateral that lost credibility, which then invaded everything else. In more recent regional episodes, social media accelerated a classic duration mistake into a 48-hour sprint. Different decades, same physics. Confidence breaks, then liquidity, then prices, and if nothing stops the loop, solvency. So what breaks first? The story. The story that deposits are sticky until they aren't. The story that held to maturity means priced at par, even when you need to sell. The story that you can always roll tomorrow what you borrowed yesterday. When the story breaks, behavior changes, and behavior is the bank. If you run a bank, the translation is brutal and simple. Don't fund long with money that can tweet. Hedge your duration like the future is uncertain, because it is. Concentrations hide in plain sight. Measure them, cap them, and build real relationships with the many, not convenience relationships with the few. Treat unrealized loss as a liquidity problem, not just an accounting footnote. Build collateral you can pledge on bad days, not just assets that look great on good days. And rehearse your bad day playbook when the sun is out, because you won't have time to write it in the rain. If you're not a banker, if you're a business owner, a household, or an investor, the same logic scales down. Cash equivalents are not all the same. A government money market fund that holds T-bills behaves differently from a prime fund that owns commercial paper. A bank deposit above insurance is a credit decision, whether you think of it that way or not. Spreading operating cash across institutions is not paranoia. It's ops hygiene. If you must keep balances above caps for payroll, understand your bank's balance sheet, not just its logo. If yields look too high for cash, ask what makes them high. There's no free yield, only extra plumbing. What about the fear that every banking scare means a systemic collapse? History is sobering but not hopeless. The system learns. Capital buffers are thicker than they used to be. Liquidity rules are tougher. Market infrastructure can root around damaged nodes, but systems also forget. Long, calm stretches make everyone lazy about the boring details. Hedges, haircuts, maturities, who your depositors actually are. Panics are how systems remember. They are the price we pay for designing institutions that transform time. Borrowing short, lending long, turning today's idle money into tomorrow's productive capital. The endgame of a panic isn't just who fails, it's what changes in behavior after. Banks that survive hold more liquid assets than shareholders like and fewer hot deposits than customers want. Margins get thinner. Credit gets harder. The economy slows not because anyone voted for pain, but because prudence is a lagging reflex. Eventually, confidence returns, rules are tweaked, and the cycle resets. The lesson that sticks longest is the simplest. Safety isn't a feeling, it's a funding plan. So what breaks first in a banking panic? Confidence, then liquidity, then prices, usually in that order, and sometimes in a single afternoon. That sequence is why the first line of defense is communication and cash, why the second is collateral you can move, and why the third is capital that buys time when stories go bad. If you remember that order, you don't have to predict the next headline. You just have to keep your own balance sheet aligned with reality. If this made the machine a little clearer, stay with money lore. We take the drama out of crisis by naming the parts. So when the story breaks, you know what actually matters and what just makes noise.